Hello everybody, this is the Accounting Superstar channel. Glad you're here. This is the place to learn accounting. I'm Professor Don Bush and I've been teaching accounting for about 30 years and have been a CPA for close to 30 years, and I'm glad you're here. I've got a lot of good ways to explain accounting to make it easy and simple to understand. And today we're learning about loss carrybacks. That is accounting for income taxes, loss carrybacks. And we have, when we get to it, construction, the construction company you don't want to have do a job for you. So here we go, folks. So here's how this is all laid out. I've got it color coded here year by year. So here's the very first year, 2000 and X1 here. I guess we could call it 2001. And it's yellow here, so we've got the tax form and the journal entry, and we have the GAAP income statement, generally accepted accounting principles, and generally accepted accounting principles balance sheet. So here we go. We're going to learn about loss carrybacks. So in the very first year, 2001, when we get to a construction, had taxable income of $10,000 according to their tax form. And they are in the 40% tax rate, so they had to pay taxes of $4,000. So in 2001, they made this journal entry: income tax expense $4,000, income taxes payable $4,000. There was no deferred income taxes, no deferred tax liabilities, no permanent differences, and so the journal entry is that simple. Now coming over here to the generally accepted accounting principle income statement. Pre-tax income is $10,000, taxable, same as taxable income of $10,000, and again that's because of no deferred tax assets, no deferred tax liabilities, and no permanent differences. And you're wondering, if you're wondering, what am I talking about here? Well, watch some of the previous videos and you can learn about deferred income tax liabilities and deferred income tax assets. So going on here, so pre-tax income 10 grand. And down to the income tax expense, well, it's currently here $4,000. That's how much has got to be sent in. So the amount of net income here, bottom line, is $6,000. Coming over to the balance sheet, taxes payable $4,000. Where do we get that? That comes right off the journal entry here. So all is good, very straightforward, probably principles of accounting 1 level here so far. So coming down to year 2. Now year 2 is identical to year 1, and you'll see why here. I'm just trying to keep it very, very simple so you can see the points. So identical to year 1. So here we go again real quick. Taxable income off the tax form $10,000. Income tax payable 40% tax rate $4,000. This is all according to the tax form. Income tax expense $4,000, income tax payable $4,000. There's your journal entry. Coming over here to the generally accepted accounting principles income statement. So pre-tax income $10,000. It happens to be the same thing as taxable income. That doesn't happen very often. But there were no deferred tax assets, no deferred tax liabilities, and no permanent differences. And so the current income tax payable this year is $4,000. And again, the bottom line net income is $6,000. Coming over to the generally accepted accounting principle balance sheet for 2002. Taxes payable $4,000. Where did we get the $4,000? Well, here it is right here from the journal entry. All right. Easy stuff so far. Now here's where the story gets a little different. In the third year here, folks, when we get to a construction company, suffers a loss. According to their tax form, they had a loss. I don't know why they had a loss, but they had a loss. And so the taxable loss here is $15,000. And so the income tax payable this year is 0. You only pay taxes when you make a profit. You don't pay taxes when you have a loss. And so the journal entry that we were making looked something like this: income tax expense, income tax payable, and it is 0 because no tax is due. However, when we get to a construction is making another journal entry, they're debiting tax refund receivable for $6,000 and benefit due to carryback $6,000. Now, where is this all coming from? Where is this what is this journal entry about, and why is it $6,000? Well, here's what it is the income tax laws and rules and IRS regulations have a provision. And they say that when you make a profit, you get taxed and you have to pay taxes. But when you have a loss, it's not very fair that you don't get some kind of a tax break. So the IRS regulations, probably because the IRS are made up of such nice people and it's such a nice organization, that they say, hey, we're going to cut you some slack here. We're going to give you a break, and we'll help you out a little bit. So what you have to do is you have a choice. You can look back 2 years and you can say, hey, did I make a profit 2 years ago in each of the 2 years or any of the 2 years looking back? And if the answer is yes, well, then you can get a refund that's appropriate and proportionate to the amount of loss that you have here. So, and that's the example that we're going to do today. But also what you can do if you want is you can look forward and you can say, well, I don't want to look back and get a tax refund, but I'm going to just save this taxable loss for maybe next year or the year after. And the way the current IRS regulations are right now, you can carry this loss forward for 20 years. So in our example here, we're just going to use the carryback. So let's go back and refresh ourselves. Now keep in mind that the taxable loss this year is $15,000. So going back, and you have to go back to the second year, first year. So you have to go back to the earliest year first. And they had a profit of $10,000, which is great. Okay, so let's get this refunded here. Let's get this $4,000 refunded that we paid in tax due to that profit that we had. And let's take another 5 for the second year, because 10 and 5 will equal our loss of $15,000. So once again, we're going to come back here and say, hey, yeah, we had a profit of $10,000. That offsets our loss. We'll get a refund of this $4,000, and we still have $5,000 of loss left to take. So we'll say, hey, let's take it from year 2. So $5,000 of loss. So what you would do is multiply that by 40%. $5,000 of loss by 40% is $2,000. And if you think about it, $5,000 is half of $10,000, so we'll get half of this back. So here we go again. We're going to get this $4,000 back and $2,000 of this. $4,000 and $2,000 is $6,000. So here we go. That's where we get the $6,000 for this journal entry. It's just that easy, guys. And of course, if need be, we don't need to in this situation, but if we did, we could carry our losses forward too. And by the way, these rules and laws change from time to time. I remember when I was in school a long time ago, it was that you could carry back losses 3 years and carry them forward 7 years. So things have changed quite a bit. So coming over here to the income statement, here's the pre-tax income, a negative $15,000, which is identical to the tax form. And the reason why they're identical is there's no deferred tax assets, no deferred tax liabilities, and no permanent differences. And if you're still wondering what I'm talking about, watch those other videos. So the current tax due is 0, but the IRS, since they're so kind, they're going to give us benefit due to the loss carryback. And where's that $6,000 coming from? It's coming from right there. So that means that our overall net loss is $9,000. So they're helping us out a bit. That'll be great. Over here to the balance sheet, we have a tax refund receivable of $6,000. We get it off of that right there, the journal entry. Tax refund receivable. We have taxes payable of nothing. Folks, that's all there is to a loss carryback. It's really quite easy, nothing to it. So if this video helped you out and you liked it, hit that like button, subscribe for some more of these, and we'll see you next time. Over and out.